Exxon Chairman and CEO Darren Woods meeting with investors yesterday at the New York Stock Exchange. This was an important appearance for Woods. Exxon shares have fallen more in the last year than in any 52-week period since the Exxon-Mobil merger, under pressure from a global drop in oil prices. Exxon and Woods are undeterred, however, in trying to continue to invest. He said Exxon-Mobil's leaning into a CapEx plan that would see the largest American oil and gas producer spend $30 to $35 billion annually on projects around the world. In yesterday's presentation, Woods admitted that 2020's CapEx would be at the lower end of that range, under $33 billion. We spoke to him about this investment and about Exxon's strategy for weathering market volatility.
For us as a company, and as we've talked about before, we've got to take a very long-term view. Yeah. And the investment cycles that we make are anywhere from 5 to 10 years. And so our strategy in laying out our plans is to make investments that are robust to these down cycles, and so that you can ride through them. We've got a key competitive advantage with the balance sheet, and so we build these advantage investments. They're robust to the down cycles, and then we use our balance sheet to kind of ride through these turbulent times and make sure we can deliver on those projects that then form a platform for our business to grow earnings and cash flow for the long term.
That makes sense, but maybe the oil market's even more important for you. When you're watching oil today, like we are, at oil at $47 a barrel, does any of that make you nervous in terms of what it means, even though you're looking at longer term? You got to be looking at some of these things and thinking, wow.
Well, you know, if you put it in perspective, in fact, I did that today with the investors, it's easy to get caught up in the short term, in the moment of the markets, but when you step back and look at a lot of these commodity markets, you've seen these price swings before. So we've been in this territory before, and that's why when we're making the investments, we make sure they're robust to those down cycles. So the investments that we're making in Guyana and the Permian are all robust, even below $40 a barrel.
Below $40?
Below 40. So the intent there is to make sure that you're robust to it, so that when you find yourself in those circumstances, you don't regret any of those investments.
When you stress test it, you said that makes sense for a lot of these investments below $40 a barrel. How low do you go when you're running these scenarios?
Well, we look to see, we don't have a cutoff. What we look to see is if you look at the fundamentals of those projects and then test them under different price environments, how do they respond and what do the returns look like? And if we get to a broad enough range, if you go back in time and look in history, oil tends to move over time between $50 and $70 a barrel.
Right.
Kind of a reasonable range. It'll drop down for periods, but it doesn't last very long down there. But
what if it did? What if this time's different? And I say that simply because of what we're seeing with coronavirus and what that could mean from an economic impact around the globe, starting with China.
So I think what you'd see happen is a lot of industry would pull back.
Yeah.
And particularly if you don't have advantage projects that are going to generate returns in those lower price environments. The economy, I think, over the medium to long term is going to continue to grow. So the demand for energy, which is closely linked to economic growth, is going to continue to grow. And so I think what you'd see eventually is that capacity that's online, as it declines with natural attrition, you're going to get a supply and demand gap between what's available and what the world needs from an energy standpoint, and then prices will come back up again.
I mean, the oil prices are down today. Last I checked, 1%, even after OPEC said that it's going to make this big cut to production. Why do you think that is?
People are taking a position on what the economic growth is going to be, I presume, and then what the demand will be associated with that. Frankly, again, I come back to, we're not in the business of trying to figure out where prices will go, but instead make sure that the investments we make are robust to those price sets. It comes back to the fundamentals. We keep looking at what's going to drive the demand for oil and gas, what's going to drive the demand for energy, and it's going to be economic growth and people moving up into the middle class with their prosperity growing. And our view is that's going to continue. It may get slowed down for different reasons. Maybe the coronavirus slows some things down for a while, but you're not going to stop for the medium to long term. People aspiring to a higher standard of living and economies continuing to grow.
That makes sense, again, from the projects and the profitability perspective of that, but there have been some numbers run just in terms of paying the dividend. You guys have a very high yield, 5.7%.
Right.
JP Morgan ran something that said they think oil prices would need to be at around $81 a barrel for you to be able to pay out the whole dividend versus, I think, $63 is what they put for the rest of the U.S. group. How do you look at just in terms of shorter term paying the dividend over that period of time?
So I think, we have a balance sheet that allows us to do this. We have a capital allocation priorities, making sure that we invest for the long long term so that we have the sustainable growth platform, making sure that we pay a reliable and growing dividend, making sure that we maintain a balance sheet that allows us to ride through those cycles, and then if we've got things, extra cash going into buybacks. And so that balance sheet that we've historically had is built for times like this to ride through it. Frankly, the way we look at it is we're generating enough money to pay our dividends. What we're using a balance sheet for is to make these strategic investments that are advantaged versus the rest of industry and will be required as economies continue to grow and demand picks up.
But to pay the dividend, if oil prices stay low, let's say the economy suffers for a while longer, would you cut back on some of those projects that you've been investing in? Would you buy back fewer shares? How would you do that?
So what we talked to the analysts today about is we've got flexibility. We've got a really robust portfolio of investments, and they have different time cycles associated with them. So some of them we can pull back and defer some of that spending without losing the advantage of the project and without diminishing its value. And so we've already started to do that, to pull back on some investments, recognizing the environment that we're in, without changing the structural improvements that we talked to the analysts about 2 years ago. And today what we told them is we've been delivering on those structural improvements. We're on track to double earnings and cash flow by 2025 compared to when we first rolled this out in 2017. So we're on track with all that, and even with the deferrals that we have put in place, we're still on track to that. We have put together over the last several years an investment portfolio that's the best the company's had since Exxon merged with Mobil. And so it's a really rich opportunity set. And it's an organic investment profile, the program that has very high returns. It's robust to these low price environments, so we've been advancing that. We've got balance sheet capacity. If a unique opportunity was to present itself, we could take advantage of that. But it would have to be pretty attractive to compete with the organic things that we already got in the portfolio.
Speaking of Exxon-Mobil and the merger of the two, we've also seen the biggest pullback in the shares since the merger of Exxon and Mobil together. Does that get frustrating for you?
Well, I think, the market, it's hard to draw conclusions from the last several weeks. And I think more generally, the energy market or industry has been out of favor with investors. But again, I think it kind of comes back to the cyclicality that we see in this market. Energy is going to continue to be needed for a long time to come. Oil and gas will be needed as a form of energy for a long time to come. So I think, we've got to be a little bit patient, let the market kind of move through its highs and its lows.
We will have more with Darren Woods coming up in the next hour. I talked to him about what Jim Cramer has been talking about how millennials don't want to invest in these companies, and we'll get his response to that too.